All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. With me today, I'm happy to have Richard Sosa. Richard is the co-founder of Think AIN. Is it Think AIN or Think AEN? We just said it.
Think
AEN. He's also the host of the Riches and Niches podcast. So I've got a little bit of a competitor on here, but that's okay because I really enjoy the Riches and Niches podcast. Richard, how's it going?
So I'm going well. How you doing?
Doing good. Hey, let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. Everyone should do their own research and keep that in mind. And then the second way I start every podcast is with a pitch for you, my guest. I guess I'll give two pitches for you. First, I mentioned up front, Riches and Niches podcast. It's very similar to this podcast. A lot of times it's people coming on, particularly microcap companies, pitching microcap companies, giving you detailed history. My buddy Dave Waters has been on several times, and I've certainly listened to those. So that would be the first pitch. And then the second way is, just a pitch for the company we're about to talk about. Back in February, I said, hey, I'm looking for ways to play the SPAC boom. I want kind of picks and shovel plays. And the only person who mentioned the stock we're going to talk about today was you. And you said, this is the most obvious way in the world. This company is way undervalued, whether you think SPACs have legs or not. I ignored it because it had spin dynamics. I looked at it in the past and I thought it was broken, and shame on me because the stock is a triple in 10 months since then. So good for you for staying up to date and kind of rethinking the story as things evolve. So that pitch out the way, I'll just turn over to you. The stock is Donnelly Financial. The ticker is DFIN. I'll give it to you. What is DFIN and why are we so interested in it?
All right, perfect. That's great. Thanks for the intro, Andrew. I really appreciate you having me on. Look, I'm passionate about three things. One, investor education. Two, storytelling. And three, niche investing.
Are you passionate about baseball too? Because I saw throws lefty in a profile somewhere, and I feel like there might be baseball as well. And I see a football helmet back there.
Yeah, I'm a big football guy. I like baseball growing up. I guess I'm a pretty big baseball fan. I'm from Northern Virginia and like the Washington Nationals, and kind of was excited to have them come from Montreal. And of course, yeah, I like sports. I like the competitive nature of it, and I'm a big Washington sports fan.
But not to get you off track, passionate about niche stocks.
All right. So first, on the investor education side, thank you for having me on the show. I'm a big believer in people doing their own research, right? And with investing in stocks and really in any asset class, the more education you have, I think the better. And your show does a great job into just finding people and having them talk ideas. Because at the end of the day, people have to get their ideas from somewhere, and ultimately it's the conviction level and the sizing that make great investors, right? And it's really just being in front of ideas. I think it's super important, and it's why I started a podcast, and why I like your podcast, and why I like a lot of podcasts. It's out there. Everyone's got to find what's comfortable for them. So I think it's great that you do it. I like your format, really simple, and it breaks it down and it goes into a deep dive on certain names. So I think that's great.
I appreciate that.
Just with that, I like getting swag from people I'm passionate about, and people that where I believe in the mission. And On Ramp Academy, it's a firm started by Tyrone Ross, this On Ramp. And what I believe they do is they provide registered investment advisors with tools to invest and manage crypto assets. And they also have On Ramp Academy, which is really just investor education. And they sent me this a couple of days ago, and I said, you know what, this is kind of a perfect place to put this on, because again, just on education. Like I have some thoughts on crypto, but I'm not going to share them here. But what I do believe in is education. If you're going to invest in anything, you got to get up to speed, and there's really no excuse, because there's plenty of resources out there.
And for people who are listening on the podcast, because we're doing this with video over Zoom, but most people actually listen on podcasts, Richard is wearing an On-Ramp sweatshirt. So that's the swag he's talking about there.
All right. I appreciate it. And then, on the niche side, niche markets by definition, they're smaller. And because they're smaller, they generally attract less capital and less competition. That's why in my day job, I like finding managers that are experts, or what I call masters of niche, right? They're because there's less capital and less competition, I believe you have opportunities for outsized returns. And as a personal investor, I kind of have the same philosophy. And I look at stocks where I believe, look, there's not a lot of capital here, but maybe at some point there will be. And like Andrew said, like there's not investment advice. DFIN is just a company that I was fortunate enough to be at the right place at the right time. And then there were some things that happened over the last few years that kind of raised my conviction level on the company. So wasn't sure how to start on DFIN, but I think what's the best way to describe it, and I'm going to read this straight from their 10K because it's very simple. What do they do? You ask me. They provide regulatory filing solutions, software solutions, print and distribution solutions to public and private companies, as well as mutual funds and other regulated firms. So they're really kind of a one-stop shop for public companies, private companies, and investment managers. Like they file, they'll print stuff. When a company does a deal, does M&A, like they're really the leader in that. That's what they do. Before I go into DFIN, I wanted to kind of give a background on the company and why I think it's so cheap. And I think it's important to understand where the company is, where the company had been to where it is now. So this company was part of a larger company called R.R. Donnelly, which was a holding company and kind of a jack of all trade printer. I mean, they basically printed everything. They had this financial services arm. They had a magazine arm. They had a traditional book, they had a textbook. I mean, they did everything, right? And it was a roll-up strategy in a 150 or something year old company. With DFIN really being, most of DFIN was acquired at R.R. Donnelly over the last, from like 2005 to 2010. So it's really was the newer part of Donnelly. And in 2015, as you can imagine, the printing business was hemorrhaging losses, right? And it was just, look, at the end of the day, people were printing less stuff, right? And the company had, since it had been built really on acquisitions, had a ton of debt. And there were some good parts and some not so good parts. And in, I think, 2015, they made a decision, hey, we got to split this up. Like, this doesn't make any sense. Being this big company with just a lot of debt, we have to realize value in some way for shareholders. And really, I think to remain, to not go bankrupt. I mean, it was bad. So at that time, they decided to split up into three. And from what I've heard, like they always split it up where they'd remain. R.R. Donnelly would be just, some of the traditional printing stuff. LSC Communications, that was really the magazine and textbook printing that they did for clients. From my understanding, that was always split up to sell to another company. And I'm blanking on the company now. For some reason, I'm blanking on it. Not important. It was intended to sell that company, and they actually had a merger in place, and the FCC came in and said no.
Oh, I actually remember that. Yeah, I remember that, and I remember because loose memory, but you're right. I think it's like textbook or magazine publishing or something, and the FCC blocked it. I remember, I'm friends with several M&A involved people, and all of them were like, especially the libertarian ones were like, all right, I understand there's a need for antitrust, but are we really concerned about magazine publishing right now? Is that really where the competitive landscape is?
Exactly. That's exactly what happened. And so with DFIN, it was always kind of set up, spun off to sell to Broadridge. It was just the most complementary business. And it was, and then not to mention the synergies, right? Broadridge, people don't know this. Like, I'm shocked. I've actually spoken to Broadridge investors. The 20% of their business is printing documents. Like they print a ton of proxy statements. That's where they print most of their stuff. I mean, they don't. I don't even think you can find the word print in their filings. But
that's really funny.
They print a lot of stuff. So and they definitely don't have a print division. I mean, I'm sure you can find print, in there because obviously they have plants and there's a cost and working capital involved tied up with that space. But it's that's been an absolute monster of a company. And Broadridge spun out of ADP, I think, in mid 2005, and it's just been a nice a textbook compounder, right? Like the core business has got a nice moat, very little competition, but it's in a slow growth space. I mean, ultimately you need more proxy battles, you need more companies, you need more these things happening, and there's not a lot of growth there. And but it was a highly cash generative business. They go out, they do deals, and they've just been doing that. Even though it's only growing 3 to 5% a year, they've been doing that. And now the thing trades at like, I don't know, with 27, 28 multiple, and it's just a nice stock. Stock, a coffee can stock. It really is. I mean, look at the chart. Boom. So I give that background because it's important to understand that R.R. Donnelly was a mess, right? When they bought, from my understanding, when they bought what makes up DFIN today in like 2010, the biggest part of DFIN really was purchased in 2010. It was called Brown and Company. That's what most of DFIN is today. And from what I've read and what I understand, like there was zero invested in the business. They didn't invest anything, right? And over the next 5 years, I mean, you had competitors come up and say, like Workiva, and say, you know what? We're just going to take market share. I mean, Donnelly was doing some digital stuff, filings, and they were doing some electronic stuff, but they weren't investing in it, right? They were just had the moat, right? They had the business. They didn't really care. I mean, and then nor could R. Donnelly do anything, right? Which part of the reason another part that spun it off, like now as its own company, it could do all these things. So you had a lot of underinvestment for really 5 or 6 years. I mean, you had no investment in what was Donnelly from 2010 to 2015. You had none.
So it's, I mean, I put this up, but this is classic spin dynamics, right? For about 6 years before R. Donnelly buys this business, and then it's not their core business. The company's a little over leveraged, and they're just, not only are they not paying any attention to it, but they're just taking the cash flow out and taking it to nefarious corporate purposes, basically, right?
Exactly.
So this spins out in 2016, and I and a lot of other people look at it in 2016. I can tell you I had this baggage until about 4 hours ago when I was prepping for this podcast, but it spins out and you look at it and you say, oh, no growth business, lots of print, probably mismanaged, and spins out, and me and everyone passes. And if I remember correctly, the first earnings report, they just missed their numbers like crazy and the stock got hammered. So that's the background, but I think you start getting interested in 2020. So what attracts you and what's kind of changed about the story since then?
So you didn't ask, but you kind of implied it, like what got me interested. I actually had been following the company. So I followed right then in 2007, probably 2017, probably right when you looked at it, because as I recall, there was a few activist investors immediately coming and telling the company sell. I was like, the company just spun off. It's not going to sell. Like, I mean, it doesn't work that way. Spin-off dynamics you can't just sell a company. I mean, I think there is usually a minimum of 2 to 3 years where you cannot even engage.
You could do it within 1 year, but it's 2 years if you don't.
It has to be the reverse. It has to be someone has to engage with you, right?
Yeah. So it's possible you could, but you could do it within 1 year, but it's 2 years is good. And then John Malone, who the IRS keeps really close tabs on, 3 years is where it's like you can do anything you want, just go crazy and they won't care. So John Malone only does it after 3 years because the IRS is on to him.
Yeah, well, that makes sense. I mean, it's for a reason for that. So that's someone called me, talking about network. I believe in investing. You need a network, right? Via podcasts, via other investors. And a good friend of mine called me. He's like, Sosa, you got to look at this. It's Donnelly. They spun this off. It's you remember RRD, like that terrible company. Like this was like their prime, like their crown jewel. And they're eventually going to sell the broad division. It's perfect. It's, the stock was at 25 or something, and it'll sell for 50, like that kind of thing. It was perfect. So I was like, okay. I looked at it and I was like, man, it was a mess. Like they spun off. So company was doing about $1 billion in revenue at the time, doing 15% EBITDA margins, generated good cash, $25-50 million, but had $600 million of net debt at about 6.5% combined interest, right? So it was manageable because it was, even though the revenues was volatile, like the cash flow, the cash was there. It was there, but still, it's a lot of debt for a company that was at the time 40% of their sales came from printing documents, 40%. So it was, and then not to mention the fact that capital markets is extremely volatile, and since most of their print stuff where they have any kind of margin or business is in the IPO, M&A, distressed debt, bankruptcy business. And they not only spun out with this mess, but over the next 3 years, there was kind of a lull. People forget this, like, from 2016 to 2018, IPOs were, everyone was private, right? You wanted to stay private. You had all these, companies that you're seeing now, they didn't go public.
It's something I was going to ask you about later, but I'll even add on to that. Not only was everyone private, I mean, people forget there were talks of what happens when not just is everyone private, but what happens when all the public market companies go private, right? Because public companies were looking and they were saying, we don't get great multiples. We think our private market value is higher. We go private. We don't have to report quarterly earnings, deal with short sellers, deal with activists. We don't have to spend, public companies, big ones will spend 10 million plus on being a public company. That's a lot of money. They're looking at it saying, what's the point? We don't raise money from the public markets. Let's go private. So there was this huge take private trend. And I think a lot of people were looking and saying the number of public companies out there keeps shrinking and shrinking. DFIN they're a shrinking business just because the company data set they're after is shrinking.
So you kind of nailed, there were two big headwinds that faced the company at that time. Well, three. One was the debt, which at the time I thought was manageable. It was a high leverage, right? You had that. You had the fact that there were less public companies. There was less and less, and people, exactly what you said. That was a headwind. I mean, in their business, their clients were just evaporating.
Yep.
The third one was the print. Like they were a business that printed a lot of documents, and you knew for a fact that they're just going to be people printing less stuff over time, and that's just a natural thing. So in 2017, I'd followed it. I think I'd purchased like 100 shares. I just wanted to follow it. Like the guy that pitched me the stock was pretty good with these things, right? So I took the time to try to understand the business, and let me tell you, it was so hard. Right? Because as you know, investors, to get a multiple, you need consistency, right? That's all they care about. Let's be honest. Like big investors, they want consistency and something that's predictable. And DFIN was not that. I mean, their revenues and profitability were all over the place, right?
Mm-hmm.
So in 2017, they said something pretty interesting. And they had an analyst day, and they said with conviction, we are not going to do deals. Right. We are going to focus on our software offerings, and over time, we're going to bring down our print business a lot. And a lot of it will just come off from less printing, but they were going to voluntarily print less where the contracts didn't make sense, and use all that working capital, really invest in the software business that, as I mentioned earlier, they're just not invested in.
Yep.
Right. So it was one of these things where that made sense to me. I was like, what I struggle with a lot of companies, it's the opposite, where they go out and like no company wants to get smaller. It's just against everything that you're taught. It's against what you make, right? To go out and say, we are going to print less. We're going to, therefore decreasing sales considerably. And then not only do that, but take that money and invest in something where we don't, we believe we know the outcome, but ultimately we don't know, right? Because we're going to have to be taking market share. And we're going to be growing market share and taking market share from competitors where we lost market share, right? So that's what they did, and that's got me more interested. And I said, okay, that makes sense. I like that. If that works, this is a home run. But how are you going to solve the volatility in the business, right? And then around that same time, they announced that their investment management business, which now makes up about 25% of the business of revenue, that business was going to lose in one fell swoop, $130 million in sales, $130 million in sales. So the investment management business was much bigger, right? So a lot of the print declines that have come in the business have come from the investment management business, from a regulatory change that said, okay, if you're an investment manager, your default setting doesn't have to be, you're not legally obligated to have your default setting be a printed statement.
Yeah, if you're a mutual fund, you don't have to send your clients printed statements every month or every quarter.
Unless they ask.
Exactly. And I just want to put in perspective, you said this regulatory change cost them $130 million in revenue. Right. This year they'll do about $900 million in revenue.
I think they'll do $1 billion. Yeah.
$1 billion, fine, $1 billion.
Keep the math simple.
2 or 3 years ago, they were doing $1 billion. So we're talking about more than 10% of their sales are getting evaporated by this regulatory change. Now, that these sales are much lower margin than the rest of the business, but that is still a lot of headwind, right? A lot of sales headwind, a pretty good earnings headwind, just to put that in perspective.
And by the way, all of that, a majority of that happened this year. So even with that, look, the capital markets business has been, no one could have predicted this to happen, right?
Yep.
Which has really changed everything about DFIN. But for analysts had them doing $820 million in sales this year, and they're going to do $1 billion. Mostly because of this $130 million in sales that they predicted, but they also couldn't, because at the end of the day, you don't know what the band's going to be like, even with the regulatory change, right? Because some mutual funds, from what I've heard, they still want to send the print. They just want to do it, right? They want to slowly roll that off instead of one.
And I can see that because if you're delivering, like when I get my bank statement online, I pretty much just trash it, don't look at it. But there is something about sending, especially in boom markets, sending a paper statement with, like a branded Fidelity, and the person sees, hey, my $10,000 grew to 11,500. Like it does form a little bit of a bond. It's the old, JC Penney. One of the things they said when Ackman took over with the old Apple guy and they tried to turn it around, they stopped doing mailers, and they said that really decreased their store traffic. And it's funny because over the summer, Bed Bath & Beyond stopped doing mailers in 2021. And next quarter, they come out and say, that was a mistake. It decreased foot traffic. And yeah, that's different than these paper statements, but I'm just saying there is brand there, right? Like a lot of people are sloping it. It does have an effect, and it is a different effect than email.
Exactly. And it is. And that all happened this year. And I believe in my heart of heart, like that's what forced them to say, we got to be careful. Like, we're losing this, this, even though it sounds good with the story that I'm telling, like, on the business perspective, they're losing a lot of business. Right. And it was profitable, right? It wasn't like it was, maybe low margin is better than no margin. I think that kind of forced them to say, hey, we need to just focus on the software, because we have this, just to reiterate, on both sides, on the capital market and investment management, they do have a moat, much more so on the capital market side, but they really are, a big player. And I'll get into that later. I just want to kind of finish my thought on that. That forced them to, I think, stay focused, because I don't like companies with a lot of debt. I don't want a company that I own to go to zero. And they were really diligent. And I think that's what, now in 2018, fast forward a year, when what I think something happened that really changed the way I thought about the company is, look, I'm not a huge activist investor fan, but I do believe some activists can add tremendous value.
Mm-hmm.
And what happened here was an activist by the name of Jeff Jacobowitz. He came in, Simcoe Capital, and took a significant stake. I mean, he owns the largest shareholder outside of BlackRock, right?
Yep.
He took a 3.3 million, 10% stake in the company. And his background is activism, but like he wants to be involved. Like he wants to be involved, and he's a software guy. Like he had a huge winning with Teller, who's on the board of that company. He was really involved in kind of blanking on that one, the print, the mailings, the stamp. What was it? Stamp company. Just recently the stamp.
Not stamps.com, is it?
Yeah, stamps.com. He was like the top 5 investor.
Yeah.
He wasn't on the board, but you see a pattern, right? Like, there's going through change, and people don't value the change accordingly, right? So he is that kind of guy. And I know you plugged in some of your podcast guests, but I believe this is the perfect time to reiterate a couple that you've had, both of us had, but you can put the links on this as well. But I want to just mention Dave Waters and Jeff Moore. And Ben Claremont, because those three, I think those podcasts were kind of, I've evolved as an investor, and a lot of those things I've evolved because of some things I've seen. And, one with Dave Waters and Jeff Moore, first and foremost, like they talk a lot about Peter Kamen and Rob Alpert and Clark Webb. Like they have a playbook, right? And that playbook just for some reason people don't get excited about in the short term, but it works. It's like, you can't predict a business all the time, but you can predict, I think you can predict people and what they're going to do. And when Jeff came in, I read about him and I already kind of liked DFIN. I wanted to own it. I didn't really own it. I think I actually traded a little bit and lost money. And the thing just went straight down. But I liked what he was doing. And by the way, he got on the board with just pretty much walked in. Like, I don't know what the process, right? There was no campaign or anything. Just came on the board. And then I think once he started, the communication was just much more focused on, we're going to build a software company. We are a software company. And that's when they announced their 44% software by 2024. And it reverberated around the company. People have talked to me. They at that point in time, I think they became a software company, and they said to themselves, we're going to focus entirely on doing this. It's going to be our mission. We're going to have to make a lot of short-term sacrifices, right? Because they had to lay off a ton of people in print, and that had to have been difficult, right? That is always difficult to do. And you know, they've quarter after quarter, they talked about how hard that was to lay off, I mean, 1,000 people or something, right? I mean, that's a lot of people. But doing that, I think doing that in 2018 and 2009, you started seeing it slowly. You started seeing the business become less volatile. The IPO market still was not that great. The M&A market was better. I think that was helping them a lot. But in 2020, when they reported the fourth quarter earnings in February, this is February, right before everything happened, they had a blowout quarter. Like it was amazing. Everything that they had talked about, boom, was just like everything. You know, the software was growing. They had the print was slowing down. You know, you could see the light at the end of the tunnel where they would eventually stop hemorrhaging print sales. Because at the end of the day, people need to print stuff, right? And they're the go-to people, right? So, I mean, it's always gonna be part of their business. So that happened, and then COVID happened, right? So I think I was just in the right place at the right time. Like I was excited already when they announced this earnings, and then, oh, by the way, COVID's happening, right? So you had these two things happen at the exact same time, where there was an inflection point where you see the business actually turning, where software was becoming just bigger and bigger, and everything they've been saying for quarters was, you know, they were actually, for the first time, I think they started this in 2019 late, they started being super conservative on like on guide on everything and giving you less information forward looking, because they were just sticking with, you know, we're going to do this, we're going to do this, we're going to do this, but you know, we can't, you know, we can't control the volatility. So that happened, and then COVID happened, and that's when I took a position. I said, you know, this company, I didn't take a position then actually because I was worried about COVID, because I was like, oh man, that's great that they're doing this, but you know, no one cares. It was the end of the world, right? And February wasn't the end of the world yet, right? As I recall, it was like things were getting bad. It was like I'll be honest, you didn't want to be in the market, right? You knew there'd be panic, right? You see senators like selling their stocks, right? And
well, you didn't find out about the senators selling their stock until a couple months after that,
right? So so then in April, they announced earnings, and they announced first quarter earnings. This might have been May. And then this was what got me really excited. And this, I believe, was all because of Jeff Jacobitz. In the heart of, no, actually, so I'd purchased shares at the bottom when, I think in April was the bottom. Fidelity had blown out. I was told that the portfolio manager retired, and they just unloaded like an 8% position, everything was blowing up. So the stock went to 450. I bought it. I bought some shares there because my thesis was these guys are doing the right thing. It's not a zero. And plus, like the bankruptcy business, that's a huge part of their business. It's not anything now because no one's going bankrupt, but that's a huge part of their business. So that happened, and then they reported first quarter, good quarter, but then they did something like wild. Like I do not see companies. You never would expect our Donnelly company to go out and they went and bought a bunch of 8.25% coupon debt at a massive discount with cash and stock. Like that is just it was I think trading like in the 80s, right? 8.25% coupon debt in the 80s, right? And they use their revolver. These are just things that you don't see companies do.
And it's a really good trade because everybody wants share buybacks, right? But buying 8.5% debt at the 80s, that is a basically risk-free 10% return. As long as, if you're going to hit financial distress, it's not going to be risk-free because that's going to push you into bankruptcy. But short of that, I mean, it's just an incredible trade.
So that's what I think the turning point for me got me super excited in the company. I was like, this is. I now, like, a big knock on the company then was like, they don't trust management, right? It's like our Donnelly people, like they're going to go out and lever themselves and buy debt, they're going to take more leverage, right? And buy companies, which they could have done. But that told me they're not going to do that. These guys, I don't know what they did in their board meeting, but to go out and do that when nobody else was doing that. People bought that. I mean, just nobody else was doing stuff like that.
Yeah. So that's great background, but let's fast forward a little bit to today, because I'm worried we're going to start running into a little bit of time constraints here. So that's great background on the story. We've got the spin, we've got everything. Today the print business is largely gone away. A lot of their business, let's say the business state, it's benefiting from a lot of trends. It's benefiting from the SPAC trend. It's benefiting from the M&A trend. We talked about that. I want to talk about two things. A, you mentioned, and you said we were going to talk about it later, the moat they have as kind of the largest provider of SEC connections. And B, how specifically are they benefiting from the SPAC trend? Because I think we can talk valuation too. I think the market is clearly saying this is a one-time boom where you and maybe the company would say, well, actually, there's probably some legs and there's probably some things on the back ends to that. So we can start either moat or how they're benefiting.
Right. So, thank you for stopping me there. I sometimes I'd like to give too much background, but it was important. So on the capital market, let's just keep away from the investment management side because it's smaller.
Yeah.
On the capital market side, which has really been a big driver, it's really accelerated all their plans. They're, 44% 2024, all these long-term goals that they had pre-COVID, all got accelerated because of this massive, we have never seen the capital markets like this. I mean, not even in 2000, right? We are 20 IPOs away from doubling last year, which was a record year, so they're the only company on the capital market side. They're the only company that can service the issuer, like full stop. They can, from being private to IPO, to SEC filings, to ERP, to SOX, M&A,
let's just talk real quick. So servicing them as private, IPO, and public. What are they going to do for private companies?
Just help the filings. They can print stuff. They can help their filings. They can help with accounting. They have so many things that they can do with that. And by the way, help you set up everything to go public, right? So, which banks do too, but they use them as well. And they invested in this business, as you can imagine, 3 or 4 years ago when everybody was going private, right? So the things they were able to do.
So that's how they would help the private side. I think the jewel, but it is quite volatile, right? Because you need IPO volume, but the jewel is the IPO business. So when a company is IPOing, what is DFIN doing from them and what are they getting paid for it?
Well, the biggest driver of sales is really printing their documents, right? They print a lot of prospectuses, right?
Yep. And it's literally just printing the prospectus is what they're getting paid for.
Printing the prospectuses, that digital filings. They'll help, set up meetings and a lot of paperwork that goes on between the bankers and then the issuers. Like they have all these remote offices. They will, they have Venue, which is a data room that helps on some of those things. That's more for M&A, but it's helping the IPO as well. So they'll do a lot of little things like that to really expedite the process. Right. And by the way, last year during COVID, like they're the prime reason why a lot of IPOs were done virtually. It's because of companies like DFIN that were able to really manage everything on the compliance side. Because I think people don't realize there's a lot of compliance related stuff that goes on when you're doing, especially an IPO. I think more so than a follow-on offering, much more so than a private offering, at least on the venture capital side. But on the IPO side, there's so many laws. There's so many laws, and you use DFIN because you know that they're not going to mess it up. On the printing side, like you can't just go to Kinko's, right, and print a document. There's so many checks and balances that go on with paperwork. It's incredible. So
talk to anyone who's gone public, and they will say the 6 to 9 months leading up to the IPO is like the worst months ever to be a manager because there's just so much going on. And as you said, it is so regulated. Like you can't do anything. I always get frustrated because, these IPO guys will have the net roadshow, right? It's netroadshow.com. And sometimes they'll have slides, but you can't download the slides. You can't save the slides or anything. It's like, I want these, I want to save them for my files or something, even if I'm not interested, but you just can't keep them. So yes, super regulated. And obviously you need someone to hold your hand because the other interesting thing is you're only going to do it once, right? You're not going to build this thing in-house or something. You have to go to an outsourced provider because as an IPO company, you do it once.
Right. So they have like 65 to 70% market share. I've never figured out the answer to this, but for some reason on the biotech side, they have an over 95% market share of initial public offering filing. So they'll literally do everything. And these things cost money. I mean, to put it in perspective, a traditional IPO, that's where they make a lot of money. On the larger side, like a large IPO, like an Alibaba, think about a big IPO, right? One that you'd read about, a big one, and they're making $2 to $3 million in sales. That's how much they get out of a big IPO. Same, maybe not so much, but on a big merger, same thing, the amount of documents and compliance related to a big merger, that's also a big moneymaker for them. And that is why the SPAC boom should benefit them tremendously going forward. And I want to just on the SPAC side, it's actually not the SPAC where they make much money on. They don't make money. I mean, to file a SPAC, literally you pay them like 25 grand or something. It's when the DSPAC, when they merge with somebody, the complexity involved, that's where they'll do as much as a traditional IPO.
Yep. And that's, you front ran me, but this is one thing the company said, a lot of people look at this year's results, which there has been a mammoth SPAC boom. I think almost 500 SPACs have IPO'd so far this year. I can't remember exactly, but people look at this year's results and say, oh yeah, you guys were a huge SPAC boom beneficiary. As I said, you were the one who said this is a picks and shovel play for the SPAC, but the company would argue, hey, the SPACs are just the beginning. Now there's 300 SPACs that are waiting for a merger target. And when all of these SPACs find a merger target, we're going to get M&A revenue from them. And that's 10 times what we got from the SPAC. And by the way, now that they're public, they're going to need somebody to do their compliance and reporting and stuff. And we've already got this great relationship with them. So that's 500 potential new customers that are going to create annual recurring revenue for us.
Exactly. And, they talked a little bit more about this quarter and but what I think is kind of a big wild card with the company is, the IPO activity, we'll be honest, like that's volatile and look, it can go away tomorrow. We know that. I mean, I worked in an investment bank, and that's my background. It could literally go away tomorrow.
Yep.
But what it has done and what you're starting to see more is that active disclosure, like that business, it's a significant part of their business. It's like a third of their software business is filing financials, actual, 10Ks, 10Qs. That has nothing. I mean, that's not a volatile business.
So that's what they do for a public business, right? If I'm a public business, I'll contract with DFIN I give them my 10K and they file it for me. Is that right? So
exactly.
And DFIN, that's on the electronic side. So we've moved on from the printing side. This is one of the growth businesses and everything. For the electronic side, is DFIN the largest provider of the electronic filing for SEC?
No, it's Workiva.
Okay. So what's about DFIN's market share on the electronic side for publics?
Well, it's on the electronic side for publics. Well, they do a couple business. They have Venue, which is the data room, right? Which you can put on the digital side. That's going to be lumpy, even though it is a software as a service business. I mean, you do pay yearly, but if there was no deals or no activity, you could see the churn be a little bit higher. But active disclosure really is something that I think they're super excited about, because that was a business that was not invested in. And they had a dominant market share, and Workiva came in, boom. We have this great platform. It's all cloud-based. You're Coca-Cola, you can be in Europe and United States, and you can all collaborate together real time. You control the workflows with your auditors and your accountants. So they did that, and they pushed that. And that company, by the way, is 25 times sales.
Are they publicly traded?
Public WK trading at 15-20% sales. It does more sales because it's bigger than active disclosure. But active disclosure, they have invested a ton of money in it, and they said multiple times that they're winning. They're taking back market share. They're taking back market share from Workiva. And so active disclosure actually grew more. Workiva grew 30% in the third quarter, this quarter. And stock went up, 10%, but it's huge multiple stock, right? 20 times sales, and obviously not making money because it's in growth mode. Active disclosure, 35% in the third quarter. I mean, so you had a company growing more. So, I mean, look, I'm not going to put a 20 revenue multiple on active disclosure, which I don't know, it probably does $100 million, but you could, right? And it's taking back market share, and it's easier for them to take back market share. Like they say, from what I've heard and heard from some clients, their new software offering was from the ground up. They redid the entire platform, and it is superior than Workiva. Obviously, that's what they're going to say, and I've heard that from some clients. But at the end of the day, people don't need Workiva if they can just do everything with Donnelly Financial, right?
So that actually brings me into two questions on the risk side I wanted to do on stickiness and competitors. So let's start with stickiness, right? When I'm a company, and obviously DFIN does a lot of different things for a lot of different companies at a lot of different points in their lifestyle, so you can't brush it with too broad of strokes, right? But if I'm a company doing SEC compliance with DFIN and I submit my annual report through them and DFIN puts it onto SEC Edgar or something, I would guess that's quite sticky, right? Because all of my 2020 numbers are loaded in there. If I want to go get a whole new provider for 2021, I basically have to reconnect the whole thing. But then when I do, DFIN gets lots from M&A and IPOs. Those are one-offs. I would guess those are not sticky. So you have to go win someone basically every time. Am I thinking about this correctly? Or is there like kind of hidden stickiness in the IPO business I didn't think about? Or is the SEC business not as sticky as I laid out?
The SEC business is sticky, and an M&A deal, it can get interesting. But first and foremost, in an M&A deal, a lot of times it's the same company. The two companies use the same providers, right? Yep. So that doesn't matter, and it'll DFIN won't matter when they're now merging and there's another competitor like Workiva, for example, or on the SS&C on the data room side. It's more competition, sure, but ultimately on an M&A deal that they're getting paid a one-time a ton of money to process that transaction, and they're right there in front of you, trying to earn the business. And because they provide so many, and this is what I haven't mentioned, because they provide all these different platforms, there's room to negotiate here or here or here. No one else can do that, right? Like they will cut deals, and in certain segments, like, okay, we'll give you a discount on the SEC filing if you do, or we can print these documents for you, right? And then vice versa, right? Whatever fits the client's needs. And they're able to do that. I believe that's why they don't give so much detail on every individual segment. They try to, but it's a challenge, right? All the businesses are intertwined. Like people in the past said, oh, we'll just split off the print business. It's not that easy, because it is so important to them, because it puts them in the front door, because everyone needs to print prospectuses. So you're getting everything. And a lot of clients will just say, okay, I'll just do everything with you.
Yep.
Right.
Yep.
It happens more and more and more. And you can see it in their numbers, where this year that they're going to grow 10% when they lost 10% of their business. Right. Like, phenomenal.
Let me ask one more question just on the M&A side, right? If I'm going to do M&A and one of DFIN's products is data room, if I'm going to do M&A, who decides and how do they decide who's running the data room, right? I'm guessing, is it the bank that's going to decide, hey, Andrew's industrial firm is up for sale. He's going to load everything up to this data room because that's who we always work with? Or is it someone else who's deciding?
That's a good question. I don't know the answer to that. My gut is it's the bank, in conjunction with the company, but I don't know. I don't want to tell you something that's wrong.
I'm pretty sure it's the bank, because I was in private equity before, and the banks would always, if it was a Jefferies deal, it would always be on whoever Jefferies was using. If it was, so I'm pretty sure it's the bank, but it could be private equity firms. I'm not.
I've heard that before, like they wine and dine at the junior banker, like, so it's never the senior person's decision for some reason.
Again, it's tougher, because if you do the bank and the bank runs 200 processes a year, the banks they've probably got a lot of pricing power there, because there's only 7 banks who kind of matter. But it's also probably extremely sticky, because if you've won the bank and the bank wants to shift, well, you're going to have an awful lot of angry bankers for 6 months who say, hey, we have to go recreate all of our models because you guys are trying to save $10,000 or something, So that's interesting. So we've talked about a lot. I want to talk about the growth of the company this year. You mentioned 10% growth, but it's actually probably better than that, right? Because they've got the print decline, and I tweeted out this slide in my prep tweets, and people can go see them. I'll link them in the show notes. But they've got the print is going down while the software business is going up. So it's 10% consolidated, but the really valuable stuff is actually growing quicker. So let's talk valuation and how you look at the kind of DFIN even publishes in their investor deck a little sum of the parts slide. How do you think about the sum of the parts and the overall valuation here?
Oof. This is a tough question, and I think this is why I went into the company in so much detail. Because the thing is, they're all important to understand, because unfortunately, it's not so simple, because, we don't know how much of it's sticky and what's not. Because, the bear case, I think people at this point understand the software it's gold and it's good, right? And the print business, it's the decline, it's manageable, because at this point, they had 40% of their business was print in 2017, 20% now. That's not going down much more at this point. right? And then all that cash that they have going into the software, they're going to generate $800 million of free cash flow over the next 4 years. I mean, 4 or 5 years, 800 million free cash flow. They have zero net debt. Like what are they going to do with that? Right? That's incredible.
I think
People
they're going to buy
nobody
back
talks
shares.
about. Let me tell you, sell side analysts don't talk about $800 million of free cash flow. What are you going to do with it? That is extraordinary. I believe they'll do buybacks and invest in the business. But to answer your question on the growth, this is really difficult because they say in their deck, right, that they believe 1 to 2%, right, going forward, and that includes some print decline and then the 15 to 25% software growth, which they believe that's how they're modeling, that's how they're running their business. But a lot of these D-SPAC, it's just so hard because they don't break down how much is one time, right? And this year, 2020, it's been a record-breaking year, and on the just even on the traditional IPO side, we've never seen anything like this. I mean, on the SPAC side, that people can talk about that, but on the traditional IPO side, I mean, there are only so many private companies, right? And you can see that this continue for a few years, and if it does, I mean, things super undervalued, right? But what I think people don't understand, and this is why I gave the background again, if you just revert to the mean, which I think is impossible to do because it's a totally different company, but if you just revert to a transactional mean, this company's still going to make $3 to $4. Like, I don't think people understand that's how it's run, because the software business, and it's becoming exponential. It's growing exponentially. Like, this is not, you can't just model. I mean, this company was doing 15% more EBITDA margins in 2017. They're doing over 30% now. And in a pullback, they're still going to be doing 25% margins.
Just to add on to what you said, because as I was researching this, the stock had run so much, I was like, oh, I missed it. It's probably trading at 30 times EBITDA or something right now, right? And it's not. It's trading at 7 times EBITDA. So I was getting really excited, right? I was like, oh, software business going quickly masks that the overall business is growing, but software business going quickly. And the two things that were jumping out to me, and you addressed one of them, it's just like they don't give they've started to get better, but they don't give perfect segment disclosure yet. And I was noticing there was lots of jumping around between, hey, like there was stuff of, is this recurring in nature versus reoccurring in nature? And then there would be lots of jump between 30% of our sales are print, but 20% of our sales are print. And it was just going in lots of different directions. And again, look, I prepped for this podcast this morning. It's not like you've got 18 months following the company, but I was very much noticing, I know I'm not doing a great job of saying, but I was very much noticing that they were jumping between numbers and stuff. And you could tell that they were maybe trying to hide something, or maybe they didn't quite know how to explain it, or maybe it's just complicated, but there was something there that was standing out to me.
No, I love that you said that, because it's the truth. I mean, I did prep for this a little bit and tried to address that problem. It is a problem. It is confusing. And then I think a lot of the time, they say 60% of their business is recurring in nature, because a lot of transactions, I mean, if you don't see it in the IPO side, you're going to see it in the M&A side. You're going to see it in other places. So I think that 60% number, they're very comfortable with that. And that's a lot of that's going to be on the software side. But just on the transaction side, it's not just IPOs. And we haven't seen bankruptcies. We haven't seen a lot of these other things that usually are a sweet spot for them. And that's what's great about business. I mean, it is, they can prepare for they can do well in different markets, right? And that allows them to be confident with their capital allocation. But I think they can't accurately predict what will happen, right? And like active disclosure, right? Like that's growing. A lot of that growth, I mean, a lot of that's coming from internal investment and winning market share, but a lot of that's also coming from the IPO business growing so much that's not one time, right? Just getting new active disclosure clients because there's more IPOs, and they're getting the business just 100%, almost probably 100% of the time.
Yep.
Right. That going forward, that will be recurring, but that, the incremental growth from the IPO, that won't be growing. Right. So I think it's just so hard for them that at this point, I think they just stop trying to explain it all, because they don't know. They cannot predict what the capital markets will do. They only give quarterly guidance now. I don't think they will ever give yearly guidance again, because the capital markets is so It's so volatile. I mean,
Yeah,
I believe,
which makes,
yeah,
but
it's hard to model, right? But you can model, you can predict what they will do, right? And you can, with reasonable confidence, know that they're going to generate a ton of cash. Like when I say 800 million, I mean that can range from 500 to 800, but that's still $500 million of free cash flow. Like for a company to $1.6 billion. So, 33 million shares out, no debt, $50 stock price, 1.65. I mean, it's not a big company. $500 million on a base case is a ton of free cash flow that they can do wonderful things with, include doing these little tuck-in acquisitions, which they haven't done. I mean, a tuck-in for a platform company can be incredibly accretive, which what we've seen from Broadridge, right?
that actually really transitions nicely to my next question, right? So this is trading 7 times EBITDA, probably less as of this year, right? Because they're growing very quickly still. They even said, hey, October trend on their Q4, their Q3 call, they said October trends were great. We're still growing pretty rapidly, right? So, but even after a big run, stocks up 3x since the beginning of the year. This is trading at 7 times EBITDA. It's not like this is unknown, right? Like I try not to read too much sell side research, but B. Riley covers it. They have a blowout Q3 quarter. B. Riley ups their price target from 40 to 52, 6 times EBITDA this year. Yeah. Say again.
Yeah, the EBITDA, their price target EBITDA multiple is ridiculous.
And they say our price target is 6 times EBITDA this year, 5 times EBITDA next year. Sell side can be wrong, right? Obviously they can be wrong. They can be too conservative. They can be too aggressive. But I'm just saying, it's not like this isn't known. The market is looking at this saying this is 7 times EBITDA business, despite the software growth we've talked about, despite the good margins, all this. Analysts are looking at this and saying this. So what is the market missing here? It feels to me like the market's worried that earnings are really inflated by the SPAC and IPO boom, and that's going to fall off and they'll go to clip. But is it something else, or you can dive a little bit into why you're not too worried about that IPO cliff?
Okay, so David Waters, again, I'll mention these, the David Waters and then Jeff Moore, because what I think everyone misses always, the sell side especially, is capital allocation and what that can do for a business. If they're taking money, they're taking working capital. And what a lot of companies do, they'll pay a dividend, right? They'll just buy back stock, which they're doing, but rarely they'll throw that money into a business that's extremely highly valued. And that's what they're doing. And that's predictable. And that's going to continue. They've already raised their CapEx guidance. That coupled with the buybacks that they're going to start doing, I believe, in mass, which, as you know, buybacks just don't get credit. I mean, you have your Liberty Bros and stuff, but at the end of the day, people don't care about buybacks. But when you have a business that could be growing revenues and EPS and is investing in the business in a big way that's transformative, plus the buybacks, like, you have this compounding effect that I think only certain investors are going to be able to see. Right. I mean, you can play the game. Oh, the software business growing 20%. It's, 25% of the business going to 44. You can put a, 10 revenue multiple on it. Boom, boom, boom. $100 stock. You can do all that math. But at the end of the day, you can't control any of what happens. But you can control that these guys are going to be investing in their business and buying back a ton of stock. And in the next 5 years, even if the sales don't do anything, I mean, they could be making $8 to $9 in earnings and have a business that's 50% software.
Yep.
Right. That it will be worth a lot more.
So let me ask you, this actually segues nicely into maybe my last question, incentives here, right? Because I was a little surprised. There is a big semi-active shareholder, I believe Simco. The guys at Simco are very sharp and they filed a 13D. So they're active, they're on the board, they own 10%. So that's nice. But I was a little surprised, like the CEO, his stock, he owns about 300,000 shares. That's worth, what am I doing the math in my head? $15 million at today's prices, right? So that's great, but he makes $4 million a year and he only has 15 million of stock because the stock's 3x this year, right? Before that, he was kind of making 4 million and he owned about 5 million. And, the board of directors, most of them own, maybe $1 million worth, but they make $250,000 a year for being on the board. And I get it's a spinoff, which means it's not founder led or anything, but I was just a little surprised, you're not seeing insider buying. The insider ownership just feels pretty low. So I just wanted to talk about the incentives here for a second, because that seemed the one worry to me. You have a business that just did this pivot and the management says, we're geniuses. let's go buy another SaaS company. Let's lever up. Let's issue equity. Let's go on an acquisition spree. We're genius here. And I was worried they might not be fully aligned, if all that makes sense.
I'll be completely honest with you. I think it is a risk. When I started conversing with other smart people that like these types of stories in 2019, they all thought it was fascinating. But they all had that one put that nobody questioned the print or the software. Nobody questioned that. What they questioned was what you just hit the net, what you just talked about was like, I don't trust these guys. Like, they were part of our Donnelly, which you saw.
That's what I was gonna say. Yeah.
Right. Yeah. Which is why they don't own a ton of stock, where they get spun it off, and all the stock that they own, for the most part, I mean, maybe 20% they bought on the dip, but most of it was given to them, right, via options and just being a spin-off company. So look, I've talked to these guys a couple times. More importantly, I've talked to a lot of people that work with them. What I do understand is they're incredibly sharp and know the business. Like, I mean, their backbone is our Donnelly, right? And what they did, they don't have direct experience in this transformation, but they've hired the right people, and they are hiring a ton of people. And then this is why I've mentioned Jeff Jacobowitz like 5 times on this call. Like, and it's really one of the biggest reasons I bought, because I know he will be in there. He's got the playbook, and they're just going out this playbook, right? They're going out this playbook that's working. It's working very well. And that gives me more comfort that they won't do. They've said it multiple times. They will not do a big deal. They will do tuck-ins, $20 to $50 million deal. They won't do a transformative deal where they take on debt. They've said that, but look, they don't have a prior case study, right? Their prior case study they're all our Donnelly people. I do know another board member, Juliet Ellis, which was and she was a big fund manager at Invesco AIM, big time small cap growth. Like, I know she's on the board. I know she's good. Like, she will. I mean, the board is pretty good. And then the management team, like, all I can say is everything they've said, they're executing, man. And from the first conference call, if you go back to their first conference call, the total mess, like, they've really improved. They've tried much better to communicate their story. And just, I see the actions. Like, the actions do speak louder than words at the end of the day. And you're seeing the execution.
Speaking of actions, one of the things I like is, look, last year they bought back shares, and they were buying back shares low, right? When this market was low. And the only time I believe there's been insider purchases in this company's history was at the end of March 2020, which is nice, but they were buying back shares when the stock was hammered and everything was hammered. And not only that, they were going and buying back their high yield debt, as you mentioned earlier. And it's one of those things, I do think actions speak a little louder than words. I know so many companies say, oh, we're going to be aggressive when the stock price goes down. We're going to hammer the bid. And guess what they do? They pull the Peloton this morning, and they issue shares when their stock's down 70% or something, or they sit on their hands, or they go and do deals instead of. And in this case, I mean, it's not to say that they won't, but you've got an active shareholder who's a board member who owns 10%. And the history of the capital allocation recently has been, we give it back to shareholders, or we retire a really high cost debt at attractive prices. So I think their actions speak to how they're looking at it. And, again, words don't mean a lot, but go look at their deck, and everything they say, shareholder focus, laser focus on shareholder returns. Like, it seems like they're running the right playbook here.
I think so. And I mean, look, the same with P10 and David Waters. They don't give any forward guidance at all. There's no hype. Like, it's all backward looking. They give you everything, and then the actions you see, it's just creating value slowly but surely. And I mean, look, they've had a much more success with prior companies, but at DFIN, it's been 5 years of the exact same thing over and over and over again. And that's why I had to give that story, because you cannot invest in this company without knowing that, because your pushback there, that's exactly what all the right investors think. But it's been 5 years of not doing that. And at some point you have to give them the benefit of the doubt that they're doing the right things. And then they're actually just doing what they said they're going to do.
What do you think the end game for a DFIN here is? I would think the end game comes in one of 4 categories. They could just keep running the business as is, grow. Eventually, I wouldn't be surprised if you saw a levered buyback model. Again, Simcoe's on the board. You can go look at their 13F. They're in Altice as well. Altice hasn't been running the levered buyback model properly recently, but clearly Simcoe knows the levered buyback model, right? So that would be one. Number 2, they could sell to private equity or strategic buyers. You mentioned Simcoe with stamps.com, obviously strategic buyers, private equity there. Or number three would be they could go do a transformational deal, hopefully one that creates a lot of shareholder value. Or I guess number four would be they could do some mismatch of it where they do some levered buybacks and they do strategic bolt-on and stuff. But if you had to guess, what's the end game for the company here?
Oh, so I
just
really
predict the future for me right
okay,
here, right now. Predict the future.
I'm going to predict the future. I don't want to, this is just my thoughts. I don't think they'll do a transformational deal. I would not be super excited for them doing a transformational deal. They don't have the multiple. And I think there's enough investment opportunities within their business. But look, the reason why I want to talk about, I mean, that free cash flow, they never had this problem, right? Because they had a ton of debt and they were essentially forced to buy back. Yep. They were forced to pay it down because of the terms were ridiculous. And they had this window last month, which was for me another inflection point. They could pay it all back with the revolver, and they did. So now they have essentially, as of the end of the year, they're going to have the net debt zero. So they can do whatever they want. They can do a lever recap, which will be accretive, right? They could raise a ton of money. I mean, they could do a $300 million debt deal and buy back a ton of stock. Man, and then look, I do believe in my heart of hearts, this was always set up to sell to a Broadridge. But let me tell you, the time for Broadridge to make a deal, it's going away. And I want to say this on this call: if they don't make an offer for DFIN, they're not going to be able to buy it. I mean, at this rate, they're going to keep on investing in their business and growing. And as soon as that revenue number is able to turn consistently positive, I mean, this stock is going to have a massive re-rating, because it is ultimately, and they're working on it. It is a pretty simple business to understand. If you really, I mean, they do a little bit of everything. They have software. They generate a ton of cash. They have a nice moat. It's a nice business, and it's super cheap, right? Right now, I mean, the valuation is so low that they can be wrong and things can turn in such a big way, and it's still cheap. And then you got all this cash flow to buy back stock. I mean, you have this amazing things happening. I think they will. One, I think they're done with their buyback. I think they just finished it, honestly. They're going to announce like $100 million buyback, right? I believe they'll, over the next few months, they're going to announce, they replace their $50 million. I think they're going to complete and do $100 million, buyback, which it's not a lot at the end of the day, right? They're going to invest more in their business. And I don't know, a sale could happen. I would be happy with it, honestly, but we are seeing a turn in the investor base. I loved seeing the 930 holders. I mean, we saw Wasatch, which is a really smart investor, come in, and Rice Hall James is a huge investor. These are big, SaaS conversion holders, right? So you're getting the institutional interest. The stock is going up, and when the stock price goes up, things happen.
It's interesting you mentioned the multiple it trades at, because one of the things you would hear at the height of the SPAC boom, when they were announcing deals, public companies would be like, oh, well, if we were getting taken over by a SPAC, we trade at 10 and a SPAC would take us out at 30. And it's just funny because DFIN is benefiting from the SPAC boom, and they trade at 7 times EBITDA. And when you just saw the numbers, especially if you could just X out the print number, just bring it all to zero right now. Obviously, you'd actually lose money there. But if you just looked at the software business side of this and a SPAC was taking it private, I think it would be a 40 or 50x EBITDA business, or it would trade at some revenue multiple or something. And right now it trades at 7 times EBITDA. And it's just surprising. And I think you're kind of right. It's a rotation in the shareholder base from, hey, we were here for the low multiple, we were here for the spin dynamics, to eventually, especially as print continues to lose those headwinds, I think it goes to, hey, this is a compounding, maybe not perfectly SaaS, but SaaS-like business that, forget 7 times EBITDA, 7 times sales might be the right number or something.
That is what I believe. That's why Simco invested in this. I believe that's why Rice Hall James and Wasatch, I believe that's their primary drivers. Like this is not a short-term thing. If they get bought out, they get bought out, whatever. But if their software continues to grow at what you just saw in the third quarter, which, I mean, the stock price up 25% in 15 days. If that continues, that's what every investor coming in is going to care about, their software growth. That's all they're going to care about. They're not going to compare about the capital markets volatility. They're going to look at the software and be like, in bad markets, that's still growing. In good markets, it's growing a lot. And it's becoming more and more of the business. It's gonna be 50% soon. I mean, in a couple of years, that's ultimately what anyone's going. I think that'll be the story, and that's why I say, look, if someone wants to buy it, they better do it now at the top of the market, where they have to have a fiduciary duty to say, okay, we have to sell, because you know what happens when deals happen. I mean, because once that turns, you don't know what's going to happen. So I'm excited. I think that's it's so hard with the end game, which you don't know. We don't know, right? I do know there seem to be marketing less, which is a little bit odd, but I don't like
I am a little surprised. I think they do one conference a year, but I subscribe to BAM SEC and I look through the transcripts, and there's no conference transcripts where they're laying the story out or anything. They do have an investor presentation. I was a little surprised by that, but I'm cool with that. I'd rather my companies manage the business instead of go to conference, but it's a capital markets business. I kind of thought maybe they go to these conferences, pitch investors for half and maybe pitch bankers for half, but it makes sense. Hey, it's been over an hour, but I always want to give the guest last word. Anything we didn't talk about that you think we should have talked about? Anything we kind of glanced over that you wish we had hit a little harder or anything?
No, it's good. And look, what I did want to, education is very important as an investor. We did talk a lot about the risks, and those risks are very, maybe we should have started with them. This is a capital markets driven business, and there's always risks in the capital markets. These guys do print a lot, and there's risks in the print business. With any stock, there's always things that can go wrong, and just if anyone looks at this, it's a good story. They they have a lot of positive tailwinds, but I do think we covered everything. They have a good presentation on their website. Just
new presentation came out today. This morning they were prepping for our podcast.
Exactly. They had a new presentation today. There's good investors involved. There's the float seems pretty small. Like, the stock has run, and that's always hard. When a stock runs, I mean, if you look at the chart, it's been volatile. It can be, for some reason, it hasn't been volatile, but there's been some moments of extreme volatility. It's
an under 2 billion company with a 10% owner. Those are generally ripe for volatility, right? Because 10% owner wants to get out, boom, stocks going down a lot as it kind of digests that, or just bad day in the market or bad day with one seller. But yeah, cool. Richard, this has been great. Richard hosts the Riches and Niches podcast. You guys, all listeners, should absolutely check that out. I think I've badgered Richard enough where he's going to let me on at some point. So hopefully I'll have an appearance on there at some point in the near future. But Richard, this was great. Thanks so much for coming on, and looking forward to either having you on at some point in the near future or coming on to yours at some point.
Thank you very much, Andrew.